Joining us now, Steve Leisman, former Cleveland Fed President Loretta Mester. She's now a professor at Wharton and a CNBC contributor. I guess I knew that, Loretta. Congratulations. Did you send out announcements? That must have been
highest achievement of my career.
You sound a little bit I won't say sarcastic, but tongue in cheek. You think we ought to cut, Loretta? Do you think we've had a couple of money guys on that I respect their opinion. They didn't dismiss it out of hand, that maybe we are too tight. There's so much uncertainty, and maybe this time inflation really is transitory because it's just a one-time thing with tariffs.
Yeah, so I think you've pointed out sort of the tension right now in that we just don't know whether the tariffs are going to be a one-time price increase and therefore not really be inflationary for a long time. And we don't know really where things are going to land, so it's hard to evaluate what the growth implications of the tariffs are going to be. And remember, there's other policy changes coming later in the year. You know, if you think about tax cuts, they wouldn't be weighing on the economy. They could be buoying the economy. So I think it's right now to think, if you're at the Fed, what can you do with your policy tools to ensure that the increase in the tariffs don't become a more permanent or more persistent increase in inflation? And what they can do with their tools is to make sure that inflation expectations don't get out of control. And this is usually the medium and longer run, which is what the Fed's focused on. So that, I think at this point, what they're doing and what they're explaining and communicating is the right policy. Look, we're going to sort of make sure that we can keep inflation expectations anchored. That's going to help in terms of making sure that tariff increases, price increases don't become embedded in the economy and persistent inflation. And we're also going to keep in mind our other part of our mandate and be prepared if it does seem that, the employment part of the mandate is getting farther away and things are weighing on the labor market in a way that's a material downside, then we're prepared to do what we have to do. But right now, we don't know the size of that. We don't know where the tariff policy is going to land. And so right now, what they're doing is weighing those two and trying to do what they can do with their tools to ensure that inflation remains under control. And it could be that we have a benign scenario as things play out, that it is a one-off price increase, inflation measures move up temporarily and then move back down. And perhaps the growth impact of the tariffs isn't as large as some of us fear. And then we can get back to where we were before all this uncertainty with the trade policy inflicted itself. And then we could get back to where we were, where the economy is moving back towards maximum employment and moving back towards 2% inflation and rates could come down. But there's another scenario where things are not in a good place, that the one-off increases in tariffs are not one-off. There's a series of those. There's retaliations. The uncertainty continues. It weighs on the economy. And that's a bad spot to be in. There you're going to have a lower growth, higher unemployment, and perhaps higher inflation. And so we're trying to do, I think the Fed's trying to do, is do what it can do with its tools to prevent that scenario having as high a weight as it could.
When you started and were arguing, or at least making the case about inflation and how the Fed wants to be ready, to make sure that that's put to bed permanently, I was thinking all the things that you said I could have said. We want to make sure that we preempt any slowdown in the economy from the uncertainty from the tariffs and from the dampening effect on consumer sentiment. But all that is assuming that the economy really is slowing. And you point out labor's still strong, and all the fears that we've seen so far could have been, looking into the abyss, you turn the lights on, and maybe we have to fear is fear itself. Maybe you're right. But I thought I could have put in a slowdown to preempt every time you talked about preempting inflation. It just depends on what you think the greater risk is at this point. And I think the case can be made.
You're right.
And that's why we could go to stagflation.
They want to balance them. But the Fed, with its policy tool, the interest rate, isn't going to be able to prevent the kinds of things in the bad scenario, right? All the Fed can do with its tool is to sort of cushion the transition of the economy from, where we are now to perhaps a slower growth. That's what they can do, right? But we have this transition going on because this policy change is significant. These are not marginal changes we're talking about. Even if you believe that the reciprocal tariff part of it is going to be negotiated away, which hopefully it will be, you have a 10% universal tariff. You have a very high tariffs on China. So those kind of big changes, and they're structural changes, the Fed isn't really, with its tool, can't really do much about that. It can help ease the transition, cushion the transition. So it really has to be focused on what is in its control. And what's in its control is to make sure that the inflation doesn't become embedded in the economy, because that would be worse for growth too, right? The best thing the Fed can do with its policy tools is to make sure that we have price stability, because that's going to help in terms of where we end up in the economy.
Loretta,
And eventually, you're right, we might have to, they might find themselves, right, in the benign scenario, they were reducing rates because they were trying to get to balance. In the more problematic scenario, they're going to want to cushion as much as they can. But we don't know right now how big that will be, which scenario we're going to be in. So right now, what they can do is do all they can to make sure that inflation expectations remain, stable, relatively stable.